The floor beneath the silver market is cracking wide open, and what comes next could reshape everything investors thought they knew about precious metals. Expert voices are mapping out scenarios that sound impossible until you examine the structural forces now in motion. Market mechanisms that kept prices contained for over 3 decades are showing signs of breaking down completely. When physical supply becomes the only thing that matters and paper contracts lose their authority, the transition won't be gradual. It will be absolute. Make sure to smash that like button, drop your thoughts in the comments, and subscribe for more silver market content. We're diving into expert analysis that connects historical patterns with current market structure to reveal why silver's next move might dwarf anything we've seen before. The conversation isn't about short-term price fluctuations, it's about a fundamental shift in how these markets operate. For more than 30 years, price discovery in precious metals has operated through leveraged paper contracts. These unbacked instruments created a system where futures and options could influence physical market behavior. That era appears to be ending. Market analyst Bill Halter points to a profound transition underway. As paper influence diminishes, physical markets are reclaiming control over price formation. The implications extend beyond metals. The same derivative structures that suppressed commodity prices have been deployed to support equity and bond markets. When that paper influence finally exhausts itself, the result could be simultaneous crashes in traditional assets, while precious metals become extremely difficult to acquire at any quoted price. Historical precedent suggests precious metals typically decline alongside broader market crashes as forced liquidation hits all asset classes. Halter argues this cycle will break that pattern. He doesn't envision silver falling back below $50 per ounce. Gold breaking beneath $3,700 or $3,800 appears equally unlikely. The reasoning centers on supply tightness, eroded trust, and a system operating with far less flexibility than previous downturns. Waiting for pullbacks that never materialize isn't strategy, it's speculation. And when protecting capital, speculation masquerading as patience creates dangerous exposure. The focus must shift from dollar-denominated prices to ounce accumulation. Dollars represent claims. Ounces represent final settlement. Now, here's where things get really interesting, and you'll want to hear what the technical analysis reveals about silver's historical patterns. The functional transformation of commodity exchanges reveals stress in the system. Trading behavior increasingly resembles delivery and cash and carry structures. The COMEX was never architected for sustained physical settlement. Declining inventories, particularly in silver, demonstrate this strain clearly. The London Bullion Market Association faces similar pressure. Shanghai already operates closer to a genuine cash market where metal actually changes hands or transactions don't complete. This trajectory was inevitable. Futures markets fading in relevance while physical delivery becomes the dominant force. The breaking point arrives when delivery failure occurs. A participant stands for metal that doesn't exist. They cannot obtain it. Confidence evaporates instantly and completely. When that moment arrives, the market doesn't pause for recalibration. It ends. The game concludes because trust, the only foundation supporting paper claims, has been destroyed beyond repair. Michelle McCory's analysis examines why confidence matters so fundamentally. Fiat currencies, including the dollar, euro, yen, and pound, derive value entirely from collective confidence. Governments actively work to prevent precious metals appreciation because rising gold and silver prices signal declining currency confidence, making sovereign borrowing more difficult and expensive. The suppression campaign began in earnest in 1996 with Robert Rubin's strong dollar policy, which essentially positioned the dollar as desirable and gold as undesirable. For years, this framework kept a collar on precious metals prices. That collar is breaking. As it fractures, so does trust in the broader monetary system. Smash that like button if this analysis is connecting the dots, and make sure you're subscribed, because what comes next about historical price patterns will challenge everything you think you know about silver's potential. Technical analyst Michelle Oliver focuses not just on price, but on structure. Silver has broken out of a multi-decade range. More significantly, the silver-gold spread has cleared one major resistance level and now presses against the next barrier. If that gives way, history provides a very clear framework for what follows. During the 1970s, silver reached approximately 6% and 12% of gold's price on separate occasions. In 2011, it topped near 3.5%. Currently, that ratio sits just above 1.5%. Even returning to the more conservative 2011 level implies silver rising roughly 2.5 times relative to gold from current levels. Bringing gold into the equation adds another dimension. In both 1980 and 2011, gold advanced approximately eightfold during its secular peaks. If similar dynamics unfold again, gold reaching $8,000 or higher isn't unreasonable. 3.5% of that valuation places silver deep into the hundreds of dollars per ounce. These figures only seem shocking because most market participants remain anchored to recent trading ranges. Oliver emphasizes this cycle differs in one critical aspect. Silver established a much higher base, consolidated for years, and has now broken above the entire structural formation. Momentum indicators flagged the move first. Price is now confirming what momentum already signaled. When projecting previous silver advances forward on a logarithmic scale, the mathematics becomes uncomfortable rapidly. Around $500 per ounce emerges not as a prediction, but as a historical projection based on dimensional analysis. The market doesn't care whether that sounds extreme. Markets only care whether the structure permits such moves. Looking at 50 years of ratio scale charting reveals instructive patterns. The low end of historical ranges touched approximately $4 in 1993 and the mid-70s. Then silver surged to $50 in 1980, a stronger move than gold's advance during that period. Gold rose eightfold while silver climbed roughly tenfold during that multi-year advance, with significant compression into the final 6 months. After decades of sideways movement, silver reached $50 again in 2011, again with a sharp acceleration in the final 6 to 7 months. Meanwhile, gold had already blasted well above its previous high with the same eightfold pattern. Silver repeated similar dimensional moves twice. Then silver based at mid-range and recently punched through at readings above $60. This represents the first breakout from that extended range. Price charts tell one story. Momentum analysis has already indicated silver is preparing for a significant advance. Price is now beginning to confirm what momentum signaled earlier, taking the dimensional characteristics of those first two historical swings and projecting upward on a logarithmic scale produces a target around $500. On log scale charts, that represents matching the dimensional rectangle of prior advances. Some projections extend even higher. Something critical happened during those first two major advances beyond simple price appreciation. Before entering those sharp vertical phases, the silver-gold spread broke out above major resistance ceilings when measured as ounces of silver divided into ounces of gold. Clear breakout patterns emerged just before silver entered its most explosive phases. That same spread signal has triggered again. At the close of November, silver broke out versus gold above a massive horizontal structure. This breakout occurred when silver traded in the mid-50s. We're now in month 1 of what historical precedent suggests could be a 5 to 7 month surge period similar to 1979 or late 2010 into early 2011. Extreme compression into just a couple of quarters where exponential moves occur. The spread is signaling that silver will outperform gold substantially. Current measurements show silver has cleared one resistance shelf and is pressing against the next level at approximately 3.5% of gold's price. The first breakthrough occurred at 1.31%. Breaking above the next resistance would mirror the 2011 peak ratio. Looking back to the 1970s shows silver reaching 6.5% of gold's price on multiple occasions. At current levels above 1.5%, reaching just the 2011 spread level of 3.5% would require silver to advance approximately 2.5 times relative to gold. If gold advances to its historical 8-fold peak pattern, placing it around $8,000, and silver reaches 3.5% of that level, the calculation produces $280. If silver were to reach the higher historical spread levels, above 6% seen twice in the 70s, the numbers climb significantly higher into the hundreds. The critical takeaway isn't a specific price forecast or neat timeline. It's recognizing the market's foundation is transforming beneath participants still watching tickers for comfort. When liquidity thins, confidence erodes, and tangible supply replaces promises as the deciding factor, the rules shift dramatically. Instruments built on rollover assumptions and perpetual settlement lose authority once actual fulfillment becomes the test. Valuation models anchored to the past stop functioning not because they were flawed before, but because the environment supporting them no longer exists. What appears unbelievable on screens often becomes unavoidable when access tightens and positioning has crowded onto the wrong side. History doesn't repeat precisely, but it rhymes loudly when structural breaks meet public disbelief. The risk now isn't volatility in the traditional sense. It's fundamentally misjudging what kind of market silver and gold are becoming while assuming old exit strategies will remain available. When ownership replaces speculation and settlement becomes the pressure point, many investors may realize too late that price was never the real signal. The market cares about structure, supply, and settlement capability. When those factors align and physical tightness becomes the dominant force, correcting positioning mistakes becomes impossible. Participants are either positioned before it matters or they're not positioned at all. If you found this breakdown valuable, smash that like button, share your perspective in the comments, and subscribe for more sharp precious metals analysis. Stay informed as these structural transformations continue unfolding.